Disability insurance to protect income in case of illness or injury. Disclaimer: this is a sample plan and should not be considered financial advice. Consult with a qualified financial advisor to create a personalized retirement plan that aligns with your specific goals, risk tolerance, and financial situation. A sample retirement investment plan, a balanced approach. This plan emphasizes diversification across various asset classes to mitigate risk and maximize long-term growth. It's tailored for a hypothetical individual with a moderate risk tolerance and a 30-year time horizon to retirement. Investment allocation: stocks 60%, large cap equities 25%, invest in index funds or ETFs tracking the S&P 500 for broad market exposure and relatively lower volatility. Small cap equities 10%, consider small cap funds or ETFs for higher growth potential but with increased volatility. International equities 15%, diversify geographically with international index funds or ETFs to reduce risk and tap into global growth opportunities. Consider a mix of developed and emerging markets. Real estate investment trusts are EITs, 10%, REITs offer exposure to the real estate market without the direct ownership hassles. Choose diversified REIT ETFs. Bonds 30%, US Treasury bonds 15%, provide stability and safety, acting as a buffer against market downturn. Consider long-term bonds for higher yields. Corporate bonds 10%, offer higher yields than treasuries but carry slightly more risk. Choose investment-grade bonds for relative safety. Municipal bonds 5%, tax-exempt income to reduce your overall tax burden. Cash 10%, high-yield savings account, money market account, maintain liquidity for emergencies and unexpected expenses. Investment strategy: dollar cost averaging DCA, invest a fixed amount at regular intervals, for example, monthly, regardless of market fluctuations. This reduces the impact of market timing. Rebalancing: periodically rebalance your portfolio, for example, annually, to maintain your target asset allocation. This involves selling some assets that have outperformed and buying assets that have underperformed. Tax advantage accounts: maximize contributions to tax advantage accounts like 401ks and IRAs to reduce your tax liability and boost your retirement savings. Risk management: diversification, spread your investments across various asset classes to reduce the impact of any single investment's poor performance. Regular monitoring: keep track of your portfolio's performance and make adjustments as needed. However, avoid frequent trading based on short-term market fluctuations. Professional advice: consider consulting a financial advisor to create a personalized retirement plan that aligns with your specific circumstances, goals, and risk tolerance. Disclaimer: this is a sample plan and may not be suitable for everyone. Investment decisions should be made based on individual circumstances and risk tolerance. Consult with a qualified financial advisor before making any investment decisions. Future retiree, let's talk about securing your golden years with a retirement investment plan that's less blah and more bam. Phase 1, the get your ducks in a row phase, ages 25-35, emergency fund. Before investing, build a 3-6 month emergency fund. Think unexpected car repairs or a sudden job loss. You don't want to raid your retirement savings for these hiccups. This is your safety net, fam. Diversified retirement squad, they've got your back. Phase 2, level up your retirement game phase, ages 36-50, increase contributions, boost your 401k and IRA contributions as your income grows. Think of it as leveling up your retirement character. More contributions equals more retirement power. Rebalance portfolio, periodically review and adjust your asset allocation to match your risk tolerance and time horizon. It's like adjusting the settings on your retirement video game to keep things balanced. Consider other investments, explore real estate or other alternative investments, but only after you've built a solid foundation with your core retirement accounts. Think of it as unlocking new areas in your retirement game, but don't neglect the basics. Phase 3, retirement victory lap phase, ages 51. Maximize contributions, take advantage of higher contribution limits for those over 50. It's like getting a retirement superpower. Reduce risk, shift your portfolio towards more conservative investments as retirement approaches. Think of it as slowing down your pace in the retirement race, or almost there. Plan for withdrawals. Develop a plan for how you'll withdraw funds in retirement to ensure your money lasts. It's like strategizing your moves in the retirement endgame. Disclaimer: this is a general example. Consult a financial advisor for personalized advice based on your specific situation. They'll be your retirement coach, guiding you to success. I hope this helps you better understand retirement investment planning. Remember to seek professional financial guidance tailored to your specific circumstances.